Rentvesting. When done correctly, it can be the key to open up more servicing to fast track your wealth. But is it for you? In this episode, we're going to discuss the comparison of rentvesting versus owning your home alongside a few questions that you can easily ask yourself to decide if you should rentvest. And stick around to the end as I will share some of the top suburbs across Brisbane, Adelaide, Sydney, Melbourne, and even more where you could get the best rentvesting deals on the market. So taking you through rentvesting, firstly, what is it? It is essentially rent where you want to live and use the money that you may have popped into a home, you're now investing with that money instead. And this concept has become popular over the years. Now, I'm here to say it's not for everyone, but I'm also here to say that if you do it and you want to do it, what are the upsides and how it can be a major factor to actually increasing your property investing wealth. So, firstly, why do I think of this as a major factor? I take a step back and realize that many people take many years of their investing life and throw it away, buy their first home, and when they buy their first home, in almost all cases, it's not the home that they wish they wanted to live in forever. And so they have this approach to turning their home into an investment property, and they become what's called accidental investors. Now, this is a very important concept to understand because the majority of people do it. An accidental investor is someone who buys a place to live in or for other needs outside of investing, then recognizes that they may not be here forever. And then they feel like, well, why don't I go buy my next place if I can afford it, borrow it, turn my current property into rental because it's their first property, they have emotions attached to it, they don't want to let it go, they've lived in there, they like the experience of living in there, and guess what? Then most times they will not think of it as a bad investment, they'll think of all the good things that they enjoyed living in and will keep it there. So they're now preserving borrowing capacity on what may not actually be a great investment. And so what ends up happening is if you go to the cities, the two largest here in Australia, Sydney and Melbourne, and look at the large frequency of properties in first home buyer price points, the majority of them sit in suburbs that are units and potentially townhouses. And as we know, long-term growth rates in the markets of Sydney, for example, and even Melbourne, have been substantial underperformers when it comes to unit and townhouse growth in comparison to houses. Just over the long term, if you stretch data out to the 40-year mark, this average is actually close to 3% per annum. Imagine that compounding per annum for the long term, how much of a difference that could make by simply buying the wrong property type. Now, when you're buying that property type, you never think of it as, a bad decision to live in because there might be all the amenities, there might be the distance to work, there might be the coziness, there'll be the lifestyle, there'll be the actual recreational functions and facilities all in close proximity, and there'll be the convenience of it being not a huge place to maintain. Could be gyms, saunas, lifts, cafes, restaurants, all at a stone's throw, giving you that holistic life that you're after. But by simply purchasing that, turning that into an investment, which most do as an accidental investment, it's ripping into your borrowing capacity and now keeping a property there that may not be the best there to keep. It's also creating this false sense of hope and growth in your wealth building that you think that this unit in Sydney or Melbourne, as an example, is the same across many of the cities, will be a great performer for the long term. And then third, you're then having to squeeze all you can in your next uptick of your home because you're wanting that little bit better, that little bit bigger, but you're not quite at your dream home just yet. And so it's again another stepping stone. And what usually happens from here? Well, maybe you're in your 30s now, maybe you're in your 40s. And as you're in your later 40s, you're looking back in life and going, well, this second home is not quite our dream home. Our family's probably the largest it's been now. And we want to get that next layer of home. And you go one size more and maybe now you've got 2 investment properties. Or you sold your first one and then you created the second one from the home that you moved out of. And then you've got that bigger home. Now you've got 2 properties still. Again, accidental investments. And then you're looking back, you're perhaps in your 50s or even late 40s in the best cases, and you're going, hey, we need to catch up on this investing thing. We should really catch up. And then now it becomes a sprint rather than a marathon to be okay for retirement. What happens if I'd ask you this one simple question? And I say, which one would you like? One, would you like to be someone who has comfort around the shelter and the home they're living in, and you've purchased a place to live in, but you've got to play catch up for the rest of your life to make sure you're not on the pension? Or two, you've gone in and built the wealth you need to and done it so you won't be on the pension, but you have to now play catch up on the home to live in forever. And during that catch up period, you still were living in places, but just not one home that you would call yours forever. I have asked this question to almost all our clients on our journey. A lot that I still have yet to ask this question to, and I want to. But I asked this question and learned about this question in more recent times, and it's been shocking. The amount of responses that I get now that I ask this question, it's near 100% that say, I don't want to catch up on income in the future and to be just hoping to be okay and have to work to the last minute. That is now the majority of responses. So what does that tell you? People do, of course, value the family home. Both of them value it. But the majority of people wanted to value them not being stuck financially in the later years and having nothing but their family home. And this is where I truly think rentvesting is the game changer. Until you're ready to go and buy that home, that's a big difference maker for you to say, I could stay here for a long time. And so this is the key thing that you need to understand. It's not so much the metrics to the actual dollar point, which I'll go through anyway, that say what is better or not better. What you need to understand is what you prioritize in life is going to be the difference maker to the strategy you take. And if you, like many of those people ask that question, prioritize, I want to secure my financial future first, not through accidental investing, not through telling myself lies that my home that's now going to turn into an investment is suddenly the best investment out, and not through stumbling there and then getting there and then rushing there last minute to get there. No, you want to get there with a plan, a strategy, an approach, and then take a big line and draw it down the middle. And whether that was 2 properties, 3, 4, or 5, you needed to be financially okay in the future, draw that line, pretend it doesn't exist anymore. Pretend that it's like, hey, I've got no properties. And tell yourself that whether I'm in my 30s after achieving this, my 20s or my 40s, I've now achieved this, I'm done. I'm going to start looking for my home. And if I'm not there on capacity for borrowing, okay, I have to figure out how to get there. If I'm not there on the deposit, okay, I have to figure out how to get there. But this is a new challenge. Would you rather you just have that one singular challenge to go, I'm now going to find the home I live in, and that's my only challenge? Whilst you're renting, by the way, it's not like you're not in shelter. But know that your future's set. Or would you like to have the challenge of, oh, I found my home and have to figure out how to get my future set? Everyone said they wanted the first option. I want my future set, and now I'm on the journey of soul searching, hunting for solutions, income growth, savings growth, time, the right areas to live in, taking that time, making the decision firmly, not making it constantly upsizing accidental investments. So before I go into the numbers, that is the big takeaway I want you to know. You want to set your financial future up first and then transition to the home. So now let's go into the next part, the numbers. Well, of course, if you can find the sweet spot, which is, can I get the grant? Can I get my benefits? The stamp duty waivers, the pricing of interest rates, the capital gains tax exemptions, the move into a home, then turn it into an investment in the future. Can I get all these benefits, have the least amount out of my pocket to be able to go and secure a home to start my journey sooner with a larger price property because of all these government benefits, super schemes, grants, stamp duty exemptions, LMI waivers, shared equities, you name them, every scheme left, right, and center. Think about this for a minute. Let's just say you got that all across. Here is my opinion on that. If you can get that all across and you still have money left over to make the investment afterwards, that is then without bias, hey, why not? Because you get one for that and you can turn it into investment longer term. And then secondly, you can also get another investment elsewhere. And then you might have 2 investments now. You might turn into a rent investor again, or you might live in one depending on that and you're still 2 properties in. Great if you can make all things work. But here's the trick and here's the challenge. The best performing market is not likely in your backyard all the time. And the best performing market is not likely in areas where the whole population is sitting there ready for you to be able to go there and actually make decisions that are likely where you live. That is not the case at all. And I'm about to share some data with you that will give you some insights about this. So let's talk about some of these markets around the nation. The first thing here is that if you look at the markets around the country, the best performing markets around the last 12 months, we use SA3 areas, and I grabbed 15 SA3s. And with these 15 SA3s, I look at their actual performance. The performance for these 15 SA3s shows that Gawler, which is in the northern regions of Adelaide, had over 20% performance and was the highest performing SA3 over the last 12 months. Playford, another affordable region in Adelaide, had over 20% performance for the last 12 months. I'll go through a couple more examples. Barossa Valley, also in regional Australia, over 15% growth for the last 12 months, one of the top performers. Rockingham and Perth, over 14% growth. And the list goes on. If we go over to Burnett towards Queensland, 13.5%. So from regional areas to South Australia, to rest of New South Wales, to WA, and affordable parts of Queensland, you can see that the populations of all of these put together represent an extremely small percentage of markets around the nation. And so if you were to tell yourself, well, I'm going to buy the best performing market, it's always near me. Well, these markets, if you put all their populations together, they don't even represent 5% of Australia. So you're saying that you think you have the best chance to get a high performing asset in your backyard? Well, the odds are stacked against you because the top performers were in areas where they represent far lower than 5% of the nation's population. And like many first home buyers, they end up making decisions that aren't the best for their long-term investing, but they're trying to think of that, hey, I'm getting a home, I'm getting a property, I should be okay. Well, really, this has now put you back. Could you imagine what you could have done if you'd rented in certain areas and invested in these markets over the long term? But in the short term, they outperformed so much, they got you that leg up to be able to go and buy more properties and fast track your success. Because remember, if you fast track your investing success in the younger years, you can now draw that line I talked about and you can begin to invest for your future of where you live in afterwards. Let's go to the next bit of data, which is actually talking about the concept of rent vesting into the monetary pieces. The monetary pieces for many are around, well, if I can now take the dollars that I spend on rent and see the impact of the dollars that I spend on mortgage instead for a home to live in, that variance in money will help me save more, grow my wealth further as well because I could borrow more, and therefore I could invest more, giving you more income producing assets longer term to allow you to hit your goal of freedom first and then eventually get to your home living in goal. And so what's really cool about rent vesting is actually it's the opposite of what ends up happening with increasing prices in homes. So when you increase prices in homes to live in, you end up having an actual higher repayment in the mortgage. And that mortgage repayment that's higher does not have percentage variances. It continues to increase at the same rates. So a $1 million home, pricier, the $2 million home becomes priced in the 1, 5 becomes priced in the 2, a 10 million becomes priced in the 5. I'm going crazy with numbers, but I'm just trying to show you that it's an exponential rise. It rises with it when you have mortgages increase on a price of a home that you buy. But when you have rents, they do not increase the same way, because there becomes a cutoff in rental property earnings where the earnings aren't staying in line rental yield-wise as the price grows. Let me illustrate this example. A $500K property may have a rental yield of 5.2%, which is $500 per week. But as you move that property price up to $1 million, that yield could come down to 3%, which is now only $30,000 worth of rent in the year. Right? That is a lot lower than having two 500K properties renting at $500 a week each, which is $1,000. Now, $1,000 a week, all of a sudden for $1 million property, big difference, right? That's the same 5% back instead of 3%. So it's a whole 2% variance. And so as the prices go up, guess what else goes up? Council rates go up because the value of the land may be higher. What else goes up? Well, the build might be better. So the building insurance goes up as you go higher price points. So not only are you slugged with more mortgage repayments, but there's more insurance payments and more council rates payments. So overall, your number keeps getting worse the higher the property you do when you have that earlier phase of investing, phase of buying a home to live in, when really, imagine if that was rent. Guess what? You're not paying for council rates as a renter. You're not paying for insurance as a renter. You're not even paying for the strata in many cases if it's an expensive apartment. And of course, you're not even paying for the increased mortgages because the rental yield falls as the price goes higher. So what that means is you can live a more luxurious life, closer to the amenities you want, closer to the precincts you want to live in, and the areas you want that are more desirable for you as a renter than you can on the same place with a mortgage. And this is the first upside of it. So now if we do a bit of a data tour and we go around different cities, let's talk about this upside with actual dollar terms. So what I've done in this next chart is I've actually jumped here and gone through a few suburbs or regions within each major city. And if you can't see this, you're listening to this podcast, I'm still going to shout out some of the areas, but why not jump onto our YouTube page and click like and subscribe to be able to check out more video and content like this. So the first one is we're going to the region of Brisbane. And in Brisbane, we have something called SA3 regions. Again, they're just a cluster of suburbs to be able to say, I get a cleaner data set. And I intentionally picked areas where the rents are $600 to $900, feeling like that's not extremely affordable, but it's not crazy expensive. So you're still having an area where you're likely to get into some pretty good areas for this money. So with this money, what you're doing now is you're having that sweet range of rents, so you're able to be in a position where you actually get good amounts of proximity or value. And we're also seeing what happens with these rental yields in these areas. Do they drop off a bit? And if they do drop off to what you can considerably get in Brisbane, it means you're getting that outcome, which is you're getting a better area to live in potentially, but you're not paying the mortgage costs that would be to live in there because the rental yields are far lower than interest costs and mortgages. And so here we can see in Brisbane, we have Brisbane Inner West, so the inner parts. Median rent of this SA3 is $750, which represents a 2.47 rental yield to the SA3 median price. Well, guess what? You're not covering anything with that rent. That owner who's renting out that property to you is definitely not positive cash flow, like not even near anything of that cash flow that's decent if they own that property recently. If they hold that property for a long time, of course they're going to be fine, but that's because they've had it for a long time. But if you're buying in that area and you're only getting rents of 2.47%, that means that mortgage, which is what, at 5.9 to 6.5%, is going to be a lot more than the actual rent. So now you can get into the Brisbane inner markets, pay between $600 and $900 rent because this is at $750 median, and you can be at a rental yield that's far lower than that market there in terms of actually paying for repayments or interest on it. The next thing here is Brisbane Inner, $730 median rent, 2.58% rental yield. Then we've got Sherwood Indooroopilly with $725 of rent per week with a low rental yield of 2.61%. So that's Brisbane for you. It's just showing you a few regions here that have low rental yields, but are actually very well placed and getting close to the actual CBD. And that low rental yield will offset those mortgage costs in terms of the gap being in your favor as a rent investor. And now you have the rest of the country open up for where you would actually invest, as per the growth of the last 12 months showed you. It definitely wasn't in Brisbane that led the country over the last 12 months for capital growth. If we move over to Sydney now, we've got Canada Bay region with rents median at $900. And check this out, 1.79% average rental yields. That is crappy. If we go over to Ryde Hunters Hill, $800 median rent per week with 1.8% yields. Chatswood Lane Cove, $1,200 rent. Oh, this is getting pretty pricey, right? But no, guess what? 1.86% yields. These are horrendous rental yields. There's no way that that rent is getting any close to covering it. You can get all the benefits of, paying down your mortgage, rent's dead money and all that stuff. Well, you're not even going to get close to the dead money part of interest. Like, remember, that's the dead money before you actually get to your principal part of paying it down and saying it's your place, it's your own, and rent's dead money. How are you going to even touch the interest when you're paying $1,200 or getting $1,200 median rent, which is 1.86% yield? So this is clearly some great areas where you could go, why not rent? right? If we go over to Melbourne, Burundara, sorry again, I probably botched that up, but whatever it is, your yields suck. 1.83% yield at $850 rent. Stonington East, $800 rent at 1.89. The main thing is Sydney and Melbourne are with the ones and the twos, right? And so if you're in the ones and the twos for rental yield percentages, there's no way you're getting close to covering any meaningful mortgage. So, hey, if you're going to buy there to live in, say hello to reduced borrowing capacity. Say hello to taking longer time to actually buy subsequent investment properties. And say hello to reduced cash flow, worse savings, and probably a lower quality of life in other ways, because you might have this epic home, nice area, but those restaurants might not be as full with your cash sinking into that mortgage. And that is inflation coming down. So to be honest, all you low yielders living in those areas in great markets, you're probably helping inflation come down now because you're just chunking all your money into these huge mortgages with increased repayments but low yields, right? So that's what the point of the interest rate rise is, just so your knowledge to actually reduce that inflation. And so if we go across to a few more cities, I'll just take one of each from the others. We'll go Adelaide. We're going to the region of Unley, 2.65% rental yields at a $650 rent. If we're going to Perth and Cottesloe, beautiful spot by the way, $950 rent medians with 2.47% rental yields. And by the way, that's a great yielding market in terms of Perth. And you're getting 2.47% yields in Cottesloe. That is not helping you cover it. I'd rather rent in Cottesloe by the looks of these numbers. And so if we go to Hobart, one more, there was very few rents with the sort of 600 plus. Hobart Inner, right amongst it, $595 rent at 3.36% yield. So Hobart's getting more respectable. It's getting there. Even its inner markets are getting closer to 4% yield. That would be an example of where you'd say, hey, maybe I might consider buying, not fully sold yet, but might consider buying as a first option and not be too far apart. Now, what you think of rent and yields and mortgage repayments, even if you took the P part principal away, there's still interest that's higher than the actual yield that you're getting. So secondly, there's also borrowing capacity. I'm not sure if you know this, but banks don't take in your exact mortgage repayment and think that's what you pay. Not all banks do that. But guess what? With your rent, what your rent repayment is, they take that as what you pay. They actually put loading percentages on your mortgage repayment, which reduces your borrowing capacity, because you're saying that your $1,000 home repayment for a mortgage might actually be $1,200 potentially in the eyes of the bank. But then $1,000 rent is $1,000. It just is what it is. So that's a core thing to remember. Now, when you look at these markets, this is just one example, but essentially, I'm going to bring it down to a few more examples. If you took a mortgage repayment on a $1.5 million property in Sydney, and that property was an 80% loan, owner occupied on a 30-year term, that P&I mortgage on 6.6% interest rates. Now, hey, you could go interest only potentially, you could make the rates lower, arguments to be thrown either ways, is $7,936 as a repayment. Versus the rental yields for these areas are close to half that in terms of the rental costs. So you're talking about thousands of dollars. It's not a small game difference. The same thing as well if you go through a few other areas, and I'll give you some examples. Auburn in Sydney, 1.205 million median house price. House rental yield 2.93%. Monthly rent close to $3,000. Whereas the mortgage repayment, as I pointed out earlier, is going to be close to $7,900 for the mortgage itself. So even if you took away the principal component, the interest bill alone is still above it. And you can't deduct the interest for the home that you live in completely. So that clearly shows that it's not this huge tax benefit that you get from living in there either. So you need to be aware of these as you're building out a portfolio, because that will come to sting you. Now, if you're going, well, Arjun, what if I do an apartment? Well, an apartment in a popular area, the monthly rent might be $3,000 to $3,700 in Sydney. But if you take the North Sydney region and you get a $1.2 million apartment, even with a rental yield that's stronger at 3%, you've still got strata and all these other things on top that will actually impact that payment gap and make it worse. So you can see when we play that figure of 1.5 million in Sydney as an example, when you take, other parts of the country and you look at their inner markets and their rental yields, you do get better bang for buck renting instead of buying in these higher priced markets. Now, I want to give you a little bit of a bonus for sticking around this long. And with this bonus, I want to say, well, when does it make sense to buy a home to live in? I have this 3-point scale that I tell myself. And so the first part is I say, am I going to live there for at least 10 years or longer? And I tell myself this, that if I do, I get the benefits of the housing, equity, and capital growth aspect. I can then know what my budgeting is for a long time, and I can then focus on just building wealth through investing. So that first part to me is I'm not in this constant shift, change, upsize, accidental investing. I'm parked somewhere. So if you're going to be parked somewhere for some time, it can be okay, because then you get that certainty, peace of mind, and you get to make decisions for investing elsewhere. But just saying from the calcs, it won't be better off financially necessarily, but it'll be better off from making decisions, which then impacts your financial future better. The second check I have for myself is going, well, am I going to have this as part of my wealth plan where I buy it, I'm still going to push towards my investments, I have the capacity to make them happen, and then I'm going to buy a house that's big enough for me to downsize in the future, and that downsize will clear the debts of my many investment properties. And that downsize will allow me to make sure that I have capital gains tax-free downsize, which is, if that rule exists, by the way, by the time we get old. And if that helps us, then great. That helps us because I have capacity to purchase others. I can still capacity a good size property, and I can then downsize it to clear debts in my investment. So I never had to get rid of an income stream as I grew my wealth. And the third and final scenario is if it's a forever home. Look, if it's a forever home, I'm guilty of this. I'm literally purchased my forever home just recently because I've stopped rentvesting now, which I was doing prior to this home, and I've now got my forever home. How good is that? I know forever where I'll be. I know that I'm there forever, generational, downsizing, compounding, wealth building, capital gains tax-free. These are all the factors to me that make me feel like, hey, I can sit here forever because I have clarity. I know where I'll be. I'm happy to make that financial impact on that. And I've already built an investment portfolio before making that forever home decision. So investment portfolio built, forever home ticked. Long time staying in a home so you can then compound away and use that time in between to buy other assets. And then lastly, if you're in a position where you know it's part of your wealth plan, where you look to downsize it, clear debts on your investment property portfolio, it can make a big difference. I was recently with a client and we actually mapped out and saw their portfolio, and we saw that, hey, they'd purchased 4 investment properties with us, and we don't want to get any of those investment properties sold, and that would actually kill the stream of income. So we said, well, if we downsize the home in the future, tax-free, clear the debts that they have on their investment properties, they get their streams of income, and they have a downsized debt-free home to be able to live in and still call a place home whilst getting their passive income. Not including the super, with the super being on top. So that's kind of where that home can really chip in. So I hope you appreciated that bonus, but overall, if we take a big recap here, we can see some of the top areas for rentvesting when it comes to inner markets of certain cities. We can see the variance in capital growth performance, where if you'd had locations outside of your backyard, the proportion of markets that are outside of your backyard that perform better than where you are likely living is huge, and the stats are against you if you think you can beat that market in your backyard. And then the third and final part is to actually break down when the moments of rentvesting make sense and when they don't, and trying to break down the actual metrics dollar-wise is a core difference maker into your growth journey. If you like this episode with regards to rentvesting and going into the deep numbers of certain markets, actual examples, performance of where it could have been, and also how all of this can impact your future to make the decisions that are best fit for you, whether that is rentvesting or not, or jump on our YouTube page, click like and subscribe so we can put more content like this out for you, but also on our Spotify and podcast pages. If you leave us a review, it would mean a lot too. Thank you so much.